Hello everyone. Today we will discuss a very good to know topic in the field of finance, that is share buyback. We will discuss the topic from the perspective of market understanding, the objectives of share buyback from the perspective of Companies Act, say relevant provisions of Companies Act, SEBI regulations, taxation, and some recent happenings in the share buyback regime. So let's put first thing first and begin with the relevant provisions of Companies Act. As per section 68 of Companies Act, a company may purchase its own shares out of free reserves, security premium, or the proceeds of the issue of any shares or other specified security. Other specified security means, say, debentures are there or preference shares are there. So they can also be bought back besides equity shares, provided that no buyback of any kind of shares or other specified securities shall be made out of the proceeds of earlier issue of the same kind of shares or same kind of other specified security. Now, what is the same kind of share or same kind of security? So, if we go by the Rule 31D of Companies Shares, Capital and Debenture Rules 2014, we come to know the same kinds of share means shares which have the same right with respect to voting, dividend, and capital. What we conclude from these particular statement is that, say you issued a debenture, you got some proceeds out of the issue. Now out that proceed you are going to utilize in repayment or in buying back of the shares, that is allowed. But if you issued a share and you are utilizing the proceed in buying back the share of same kind, means they have similar voting rights, there is no differential voting rights, they have, say, dividend is not there in the shares, and there are same provisions with reference to capital repayment. So you cannot do that. So you can utilize the debenture proceeds in equity buyback, or say preference share proceeds in equity, share buyback, or say the equity proceeds in the repayment of debentures. So that is allowed. Uh, Besides that, the same kind of securities cannot be utilized. Subsection 2 says no company shall purchase its own shares or specified security unless under subsection 1, unless the buyback is authorized by article. Means this is the very important point. And then a special resolution has been passed in the general meeting, but provided that when the buyback is 10% or less of the paid up capital or free reserves put together, and it has been authorized by the board through board resolution, then a special resolution is not required. But at the same time, the section 2 clause C says the buyback should be not be more than 25% of aggregate paid up capital and free reserves of the company. So this is a very important provision with reference to buyback of shares. Subsection 4 says that every buyback shall be completed within a period of 1 year from the date of passing of the special resolution or, say, board resolution, as the case may be. The buyback under subsection 1 may be from the existing shareholder or security holder on a proportionate basis, that is tender offer. We are going to discuss about tender offer in later part of this video. It can be done from the open market or by purchasing of security issued to the employees in pursuant to the ESOP or sweat equity shares. Subsection 6 says that company shall, before making such buyback, file with registrar of SEBI a declaration of solvency, which is verified by an affidavit to that effect that the board of directors of the company has made a full inquiry into the affairs of the company, as a result of which they have formed an opinion that it is capable of meeting its liability and will not be rendered insolvent within a period of 1 year from the date of declaration ordered by the board. So it should not be the case that your financial position is not so good, your liquidity position is not so good, and you are buying back your securities. So that should not be the case. A declaration of solvency to that effect has to be submitted to SEBI. Subsection 8 says that where a company completes buyback of its shares or other security, specified security, it shall not make further issue the same kind of shares or including allotment within a period of 6 months from the date of such buyback, except by way of bonus issue or in discharge of subsisting obligations such as conversion of warrant, stock options, sweat equity shares, or conversion of preference shares or debentures into equity shares. So that thing is only allowed. Otherwise, you cannot issue same kind of security within a period of 6 months. Section 69 is also related to buyback provisions only. It says that where a company purchases its own shares out of free reserves or security premium account, a sum equal to the nominal value of the shares so purchase shall be transferred to the capital redemption reserve account. And the capital redemption reserve account may be applied by the company in paying unissued share of the company or to for the issuance of fully paid bonus shares. The purpose is when you buy back some shares, say you bought back a 100 share of 10 rupees, so your equity part it will come down by 1000 rupees. The security premium is going to be reduced from other equity part, but your equity part will going to come down by 1000. So the provision said that to support this capital base, at least the equity base should be kept intact. A CRR will be created of the same amount, means the face value of the shares so bought, so that the capital base is maintained or kept intact, though the CRR is not part of equity as such, it is part of other equity only. So this is more of a safeguarding measure. Section 70, again a very relevant provision with reference to share buyback. It says that no company shall directly or indirectly purchase its own share or other specified securities through any subsidiary company, including its own subsidiary companies, or through the investment company or group of investment companies, or if a default is made by the company in repayment of deposit accepted either before or after the commencement of this act, interest payment thereon, redemption of debentures or preference share, or payment of dividend to any shareholders, or repayment of any term loan or interest payable thereon to any financial institution or bank company, provided that the buyback is not prohibited if the default is remedied and a period of 3 years has been lapsed after such default ceased to subsist. Means if you have defaulted in any of these transactions, then you will not be able to do buyback transactions. And if you have corrected or remedied that mistake or that default, then after 3 years from that remedy you will be able to do so. Further, it says no company shall directly or indirectly purchase its own shares, other specified security, in case such company has not complied with the provisions of 92, 127, 133, 127, 129. So these are the provisions, I think, with reference to this annual returns, your annual accounts, your dividend, these provisions are there. So you will not be able to do so unless and until you comply with the provisions of section 92, 123, 127 and 129. Now let's come to the core part. What is it in actuality? So a share buyback is a process in which a company purchases its own stock via tender or market offer. A company generally buy back shares at a price higher than the current market price. Currently, companies can only use the tender offer method for buyback. So this is a very important definition just to understand the concept that this shares are bought back from the existing shareholders. Now, why do company do so? Why does a company do so? At what price this is done? What are the objectives behind it? And what is actually the tender offer? We are going to all these things one by one. So let's begin with the tender offer first. It's a letter of offer from the company to the shareholders in proportionate to the share being held by them. So it is one of the offer in which a company announces a fixed price. Means company will say that this is the price. Say a share is traded at 1500. So company will say, yeah, okay, I am going to buy it back at say rupees 1700. So this will be a fixed price, non-negotiable price, which is being offered by the company to the shareholders. Shareholders need to submit a buyback form in which they need to mention the number of shares they are tendering in the buyback along with the price. The minimum number of shares that can be tendered is generally mentioned in the form. The share can be tendered online using the broking platform also. So this is how it is done. Now there is a recording date concept in the buyback. So what is the recording date? Let's discuss this part. A company's board of directors approves a share buyback and announces a record date. To be eligible, an investor must be shareholder of the record date of record by the market close on the day before the record date. This is because stock trades typically take at least one business day to settle. Since this is T plus one transaction is there generally in the equity shares. So the record date is crucial for establishing the list of shareholders who will receive the buyback tender form. If a shareholder sells their share on or after the X date, means the business day before the record date, they are not eligible for buyback because they will not have those much of shares or those shares on the record date itself. If they sell on or after the record date, they remain eligible. For example, if a company announces a buyback with a record date of say 14th of November, so shareholder must own the shares by the market close on November 13 to be eligible to participate. Means end of day of previous day, at end of day you need to maintain those much of shares to be eligible to participate in the this buyback offer. Now, what are the objectives? So, first foremost objective is to increase the shareholders' value. By reducing the number of shares, the number of outstanding shares, a company can increase its earning per share metric. So, this in turn makes each share more valuable, signaling a positive financial health to investors and potentially boost the company's stock price. Suppose earlier this EPS was 10, now it is 15. Now if P ratio is intact, say 1 is to 1, so in this hypothetical example, the price will increase from 10 to 15. So this is more of a confidence of the promoters or the management that our price of our company is not actually 10, it is 15, considering the growth potential of the company. It's a signal of confidence. So buyback signals that the company's management believes its shares are undervalued because there are growth potentials which are not being recognized by the market, and that it has strong future growth prospects. Now, the third objective, it may be option to liquidate. In the case of unlisted shares, investors get an opportunity to liquidate their holdings. Why? Because in case of listed share, there is tradability is allowed. You can always trade it in the secondary market, but especially in the case of unlisted shares, they may not be able to do so. So this gives them an option to get out of those securities and sell it. Fourth one is optimize your capital structure. Optimize your capital structure means it enhances the leverage, because leverage is a good thing. Leverage it amplifies both gains and losses. So during good times, leverage is considered good because the cost of debt is lower than cost of equity. So if your debt is going up, it's a good signal for the company. But excessive leverage is a financial stability concern, because at the same time when there is a downturn in the market, there the pro-cyclical effect is there, so it will signify your losses also, because in any ways your interest or this debt payment, they are fixed. They are not subject to any profit or such contingent outcome. They are fixed. You need to pay the interest, you need to bear the interest cost, that is there. So those stability concern will be there. Now it improves the financial ratio. We discussed that the EP earning per share will improve. Once we talk about that, the EPS per share, it is going to improve. At the same time, return on equity will also improve, because you have retired some of the equities, so your return, your denominator is reduced, your return is intact, means your return on equity will improve to a great extent. Now the most relevant reason is return of excess cash. So companies occasionally find themselves in possession of excess cash with the limited investment opportunities. Instead of letting the cash sit idly, they may choose to return it to the shareholders through shares buyback. This approach is particularly appealing when the company believes that reinvesting the cash internally would not generate sufficient return. Suppose the company or the management is of the opinion that the yields are all-time low, they will not further go down, means there may not be any trading opportunity, there may not be any valuation gains in future. So investment is not a good option at this moment. So it's right time that these excess cash which is remaining idle with the company, instead of investment, because investment is no more lucrative at this point of time, so they can buy back the shares. And at the same time, they are of the opinion that the shares are undervalued, in that case, that this belief can also be protected, or the remedial measures may be taken to that extent. Then seventh objective may be to safeguard against the hostile takeovers. When a company buy back its share, so the promoter shareholding is increasing, or they so in that way the promoters, they have that much stake with themselves. So the potential risk of hostile takeovers can be obviated by share buyback. Now, some of the SEBI regulations with reference to buyback of shares, we'll have just a quick glance on all those relevant regulation. It says that the maximum buyback limit will be 25% or less. That will be that of your paid up capital and free reserve. The ratio of aggregate of secured and unsecured debt owed by the company and free to that of the paid up capital and free reserves after the buyback should be less than or equal to 2:1. Very important point, because this is not covered in the Companies Act. All shares or other specified security for buyback shall be fully paid up. Buyback from the open market through the stock exchange shall not be allowed with effect from 1 April 2025. It means that it's only tender offer is allowed with effect from this date. A company shall not make any offer of buyback within a period of 1 year, reckoned from the date of expiry of buyback period of the preceding offer. Every buyback shall be completed within a period of 1 year from the date of passing of the special the board resolution. 15% of the shares. Again, this is a very relevant provision, that 15% of the number of securities which the company proposes to buy back, or number of security entitled as per the shareholding, whichever is higher, shall be reserved for a small shareholder. Now, what is a small shareholder? Small shareholder is a shareholder who the market value of whose investment is not more than rupees 2 lakh. The date of opening of the offer shall be not later than 4 working days from the recording date. There will be recording date, and after that there will be opening of the offer, and the offer will remain valid for 5 days. So this validity is for 5 days. So first there will be a recording date. We have discussed this concept, that what actually is recording date. Then there will be an offer, and that will be validity that will be there. So now let's take an example of buyback. Recently, Bajaj Consumers Care Limited, they have completed this buyback process, and Infosys has also announced that it is going to buy back some shares of rupees 18,000 crore, and for that they have fixed a recording date of 14th of November 2025. So buyback deal outlines that Infosys will repurchase up to 10 crore equity shares, which is almost 2.41% of their share capital, and the company is going to buy back rupees 1800 a piece, in case means rupees 18,000 crore in value. Now 15% of the buyback shall be reserved for small investors. We discussed this in the SEBI regulations. The tender window will remain open for 5 working days. This is also covered in this SEBI regulations. And again, this is written that the Infosys will fund the buyback entirely from the company's reserves without taking any borrowing. Though the company can do so, we discussed this also, that the same kind of security should not be used, but the borrowing is a different kind of security. Say it's a debt, it may be a different kind of security. So company may do so, but the company has said that it has those much of security premium or free reserves which are available in the form of cash. So they are going to do it with that available cash reserves only, cash asset only. So Bajaj Consumer Care, it completed its buyback process recently. So it was the tender offer for Infosys. It will be a tender offer only, because tender offer is only allowed by SEBI with effect from 1st of April 2025. So both the shares are listed on BSE and NSE. Face value is 10, or for in case of Infosys it's 5 only. So buyback amount was 290 rupees per share, and in this case it is 1800 rupees 1800 per share. Issue size was 186 crore, but in this case it's a whopping amount of 18,000 crore. So our point is how this buyback price of 290 or say 1800 has been derived. So let's explore that area. So if you see the stock price of Bajaj Consumer in April, May and June, the average price is like 169, 170 or 182. In NSE it's like 159, 212 and 226. So this Bajaj Consumer, they bought it at 290. So you can see that there has been a premium from average price, say 226. If you compare 290 with 226, there has been a good amount of premium. Whereas in case of Infosys, the share currently the price of share is say around 1520 or say 15, it's hovering around that only. So it's almost 20% premium has been added. If you go by the return of this particular share in last 1 year, the loss has been at 20%. So the company assumes that the share is undervalued, and especially last year those who purchased the share at 1800, the company has given them an option to again buy back those shares, that the company will buy it back at 1800, because those 20% loss will be negated in that way. So company assumes or company believes that the price of the share is undervalued, and especially the fact that the company has given a negative return of around 17 to 18% during last 1 year. So under the tender offer, the pricing is fixed. The offer price is equal to higher than the market price. Now, if you go by the rule 17 of the company's share capital and debenture rules 2014, the basis of arriving at the buyback should be disclosed. So generally, as a thumb rule, valuation report may be obtained, and this is generally obtained in case of unlisted company, though there is no mandate as such. Now, what disclosure did Infosys made? Infosys made a following disclosure in the form of an explanatory statement. It says that the equity shares of the company are proposed to be bought back at a price of 1800. The buyback price has been arrived at after considering various factors, including but not limited to, and those factors are: what is the weighted average market price, like this, which has been there in this sheet, then where the equity shares are listed, price earning ratio, impact on other financial parameters, like what will be the impact on return on equity, or say your EPS, or say your debt to equity ratio, is going to be the impact on that has to be seen. The possible impact of the buyback on the earning per share. So these are many factors which are taken care by the company while deciding the prices, though as a thumb rule, buyback is generally allowed or done at a premium price only. Further, in accordance with the Regulation 5 VIA of buyback regulation, the board buyback committee may increase the buyback price or decrease the number of equity shares proposed to bought back, provided that there is no change in the buyback offer size till 1 working day prior to the recording date fixed for the purpose of buyback. Means after recording date nothing can be changed, but before that the company may do so. Now coming to the taxation part, I think a very relevant part when it comes to share buyback. The first question which comes in the mind, what is dividend payout or buyback, what is actually the difference between both of them? Now section 115QA, it said that buyback distribution tax has to be levied at 20%, and then 12% surcharge and 4% sales was there. Means effective tax rate used to be 23.296% on the distributed amount, and buyback amount received used to be tax exempt in the hands of shareholder. Means suppose the company is distributing 100 rupees, then it will reduce those 23.24% from that proceed. Means approximately your 76.76% it will be passed to the this shareholders who actually from whom company bought back those shares, but those rupees will be exempted in the hands of those shareholders. But the provision of this 115 QA shall not apply in respect of any buyback share that takes place on or after 1st day of October 2024. Means this is done away with effect from 1st of October 2024. So what is the rationale behind it? The rationale behind it is to bring the parity between dividend and buyback taxability. So until now the parity was not there, the tax arbitrage were there. Now the entire amount received in the shareholder from a buyback is treated as dividend income of the income tax and is taxed accordingly to the shareholders applicable income tax slab rate. So this was the case with the dividend, but not the case with the buyback as such, because a tax slab may go as high as 30% or even higher than that with surcharge and all these things. So as a result, company found or promoters found buyback more tax lucrative as compared to dividend payout, because there only you need to deduct this much 23.24, whereas if it goes in your high tax bracket, then it may not be, dividend payout may not be lucrative. So that arbitrage, that gap was there, that has been done away with the insertion of this provision. So treatment of acquisition, what will be the treatment of acquisition cost there? Because in case of dividend, there is no acquisition cost as such. It's just a simple payment of that return. But in buyback, you purchase those much shares and you are buying it back. So means that has to be reduced. So what has to be the treatment for the acquisition cost? It says that it is to be treated as capital loss, which can be set off against other capital gains or carried forward up to 8 years. Now, one point you need to note is short-term capital gain is 20%, long-term capital gain is 12.5%, that is without indexation, and holding period is 12 months. Means if it is less than 12 months or less than that, then short-term capital gain will be levied. Other than that, long-term capital gain of 12.5% will be levied. Now, if you see all these provisions, you will come to know when a person can sell a particular equity share and he need to pay only 20% capital gain, or say if it is long-term capital it is only 12.5%, then why would he pay this much of tax? Because when he buys back, he need to this income need to be added in his tax slab. So from tax perspective, buyback is not that lucrative, because he can sell those shares in the secondary market and he just need to pay say 20% or even 12.5% only just by holding it for more than 12 months. So that's why company has to add more and more premium, otherwise it will not remain a lucrative tool, because most of your this profitability or your this return, it will be taken care by the income in the form of taxation. On an aggregate long-term capital gain of 1.25 lakh is also exempt. So this is also one of the provisions which is there in that in any financial year, if your long-term capital is 1.25 lakh only, then it is exempted. But for unlisted shares, short-term capital gain is as per applicable slab only. For long-term capital, the provisions are same. Short-term capital gain is as per applicable slab of individual, and holding period in this case not 12 months, it's 24 months or less. For long-term capital gain, it is more than 24 months. So by reading those provisions of taxation, we come to know that buyback has not been so lucrative. The tax arbitrage has been done. It made at par with dividend, and there should be a motivation for the shareholders to accept the offer of buyback, which can only be made by providing them premium. Otherwise, they can sell it in the secondary market with a lower tax. So the impact is that recently one of the news articles stated that the buyback issuance fall 95% in 2025 as government ends tax arbitrage. So this is one of the major reasons that why the share buyback is not so lucrative avenues these days. So share buyback have lost their sheen after tweaks in the tax regime with effect from October 2024. Shifted the burden from companies to the shareholder. Issuance have fallen 95% in 2025 with just 8 such offer worth rupees 916 floated so far. Listed companies bought shares of rupees 1 lakh crore during 2020 to 2024. So data compiled from Prime database shows. So in 2024 there were 48 buyback offers worth rupees 13,000 crore. This year there are only 8 offers, and that too a meager amount of 916 crore as compared to this 13,539 crore. While in 2023 there were 48 listed companies bought back shares worth rupees 48,000 crore. Data shows. So in 2012 shares worth rupees 38,000 were bought back. So the buyback amount has been in that range, but this year it has not even touched a figure of 1,000 crore. So that lucrativeness of buyback has gone. These buyback process are added to the shareholders' income and tax in accordance with their income tax slab, which can be 35.88% for those in the highest tax bracket. This means for any promoter or shareholder who is in their 30% tax bracket or above tax bracket, buybacks offer a little incentive instead of participating in the buyback if the shareholder share their share in the open market and levied applicable capital gains. It will be more beneficial to him. So this is the reason why the share buyback this transactions have fallen so much. So I hope I was able to explain all those things from the objective of share buybacks, be it the undervaluation, be it the non-availability of adequate interest revenues, be it the expectation of the company that yield not go further, and be it from the perspective of taxation and some relevant provisions of Companies Act and regulations of SEBI. Thank you.